In 2005, Michael Burry looked at the American housing market and saw something nobody else could see. Banks thought they were making billions. Investors thought they were getting rich. Politicians praised home ownership as the foundation of the American dream. Television experts assured the public that real estate was the safest investment in America. Everywhere he looked, people were celebrating. But hidden beneath the celebration was a financial time bomb worth trillions of dollars. And while the rest of Wall Street was buying houses, Michael Burry was preparing to bet against the entire system. The strange thing is that Michael Burry wasn't even a Wall Street insider. He wasn't born into a wealthy financial family. He wasn't a famous banker. He wasn't running a giant investment firm. In fact, he started his career as a doctor. While most doctors spent their free time resting after exhausting hospital shifts, Burry spent his nights reading financial statements. He became obsessed with understanding businesses and investments. What began as a hobby slowly evolved into something much bigger. His investment analysis became so detailed that professional investors started paying attention. Soon people were reading his insights online and realizing this doctor seemed to understand the market better than many career investors. Eventually, Burry made a decision that shocked those around him. He left medicine and started his own hedge fund called Scion Capital. It was a huge risk. Most hedge funds fail. Many never survive their first few years. Yet almost immediately, Burry began outperforming the market. Investors noticed. Money started flowing into his fund. His reputation grew. People began viewing him as one of the brightest investment minds in America. But unlike most investors, Michael Burry didn't trust popular opinion. He didn't care what television analysts were saying. He didn't care what Wall Street executives believed. He trusted numbers. And in 2005, the numbers started telling a terrifying story. At the time, the housing market looked unstoppable. Home prices had been climbing for years. Banks were approving mortgages at record levels. Construction companies couldn't build homes fast enough. Everywhere people looked, property values were rising. Ordinary families believed buying a home was the safest path to wealth. Investors treated real estate like a guaranteed money machine. But Michael Burry noticed something strange. The more he studied mortgage data, the more uncomfortable he became. Most people looked at housing prices. Burry looked at mortgage contracts, thousands of them. Night after night, he sat reading through endless pages of loan documents. The deeper he looked, the worse the situation appeared. Banks were giving mortgages to people with terrible credit histories. Some borrowers had unstable incomes. Others had no documented income at all. Yet somehow, they were still receiving large loans. What shocked Burry most wasn't the risky loans themselves. It was what happened afterward. Banks weren't keeping these mortgages on their books. Instead, they bundled thousands of loans together and sold them to investors around the world as mortgage-backed securities. These investments were marketed as safe and reliable. Pension funds bought them. Banks bought them. Insurance companies bought them. Everyone believed they were safe. But Burry saw something nobody else seemed willing to acknowledge. Many of these loans were destined to fail. Millions of homeowners had adjustable-rate mortgages. Their monthly payments would remain low for a short period before increasing dramatically. When those increases arrived, countless borrowers wouldn't be able to afford their homes. The consequences would be catastrophic. Homeowners would default. Housing prices would fall. Mortgage-backed securities would collapse. Banks would suffer enormous losses. And because these investments were spread throughout the financial system, the damage wouldn't stay contained. It would spread everywhere. To Michael Burry, the conclusion was obvious. The entire system was built on a foundation of bad debt. The problem was that nobody wanted to hear it. Wall Street was making too much money. Banks were making too much money. Investors were making too much money. The housing boom had become an addiction, and nobody likes hearing that the party is about to end. What Michael Burry did next would make him one of the most controversial investors in America. Instead of investing in the housing market, he decided to bet against it. And that decision would change everything. Betting against the housing market sounds simple today. After all, everyone knows what happened in 2008. But in 2005, betting against housing was considered insane. The American housing market had been rising for years. Banks, investors, economists, and politicians all believed real estate would continue climbing indefinitely. To publicly predict a housing collapse was like predicting the internet would disappear tomorrow. Michael Burry didn't care. He had seen the numbers. He knew what was coming. The challenge was figuring out how to profit from it. There was no simple button that allowed investors to short the housing market. No convenient trade existed, so Burry approached major Wall Street banks with an unusual proposal. He wanted to buy insurance against mortgage-backed securities. If the housing market collapsed, the insurance would pay him enormous sums of money. If it didn't collapse, he would lose the premiums he paid. Most bankers thought they had found an easy customer. Some openly laughed at him. Others couldn't believe anyone would bet against housing. Yet they were more than happy to sell him the contracts. After all, from their perspective, housing prices weren't going anywhere except up. Michael Burry began spending millions of dollars every month on these positions. And immediately, everything went wrong. The housing market kept rising. Mortgage securities kept performing. The contracts he purchased appeared worthless. Month after month, money left his fund. His investors grew nervous. Then they grew angry. Soon they were furious. Many couldn't understand why Burry was risking their money on a prediction that seemed completely detached from reality. Some demanded explanations. Others demanded their money back. Several believed he had lost his mind. The pressure became unbearable. Imagine watching millions of dollars disappear while everyone around you insists you're wrong. Imagine opening financial news every day and seeing experts celebrate the very market you're betting will collapse. That was Michael Burry's reality. But while Wall Street focused on headlines, Burry continued focusing on the underlying loans. And the data still pointed to disaster. The mortgage defaults he expected were beginning to appear. Slowly at first, then faster, then much faster. By 2007, cracks were becoming visible. Borrowers started missing payments. Foreclosures increased. Mortgage companies began struggling. The same financial institutions that once laughed at Burry were suddenly becoming nervous. For the first time, reality was catching up to the numbers. Then everything accelerated. As defaults spread through the housing market, the mortgage-backed securities that investors believed were safe started losing value. The losses grew larger every month. Panic spread across Wall Street. Banks stopped trusting each other. Credit markets froze. Investors rushed for the exits. The housing boom that had fueled years of growth transformed into a full-scale financial collapse. Then came 2008, the year everything broke. Lehman Brothers collapsed. Bear Stearns collapsed. Major financial institutions faced bankruptcy. Stock markets crashed around the world. Millions of people lost jobs. Millions more lost homes. Retirement accounts were wiped out. Entire communities were devastated. The global economy entered its worst financial crisis since the Great Depression. And in the middle of the chaos, Michael Burry's trade exploded in value. The same contracts that bankers mocked were now worth fortunes. The same investors who questioned his sanity suddenly realized he had been right all along. While Wall Street was collapsing, Burry's positions were generating extraordinary profits. The man everyone called crazy had predicted one of the greatest financial disasters in modern history. By the time the crisis reached its peak, Michael Burry had earned roughly $100 million personally, while generating around $700 million for his investors. More importantly, he had proven that one person willing to question the crowd could see what entire institutions had missed. But perhaps the most fascinating part of this story isn't the money. It's why almost nobody else saw it. The warning signs existed, the mortgage documents existed, the data existed. The evidence was sitting in plain sight. Michael Burry wasn't using secret information. He wasn't breaking laws. He wasn't hacking computers. He simply did something most people never do. He looked. While others followed headlines, he studied the details. While others trusted experts, he verified the numbers. While others assumed the crowd was right, he asked a simple question. What if the crowd is wrong? That question changed his life forever. The story of Michael Burry is a reminder that the biggest risks often hide inside the things people believe are safest. It's a reminder that popular opinion is not reality. And sometimes the most profitable opportunities come from having the courage to stand alone when everyone else believes you're wrong. Years before the crash, Michael Burry saw a financial disaster approaching. Nobody listened. Then the disaster arrived almost exactly as he predicted. The rest is history. If you enjoyed this story and want more documentaries about money, power, financial collapses, scandals, extraordinary bets, and the people who changed history, subscribe to Dark Ledger and turn on notifications so you never miss the next documentary.